Hello, and thanks again for tuning in to the review of our second quarterly strategy session. I always tell you that we met right here, and the answer is this time we didn't quite meet right here. We were actually in two separate places. Both Len and Bob were here, but I was sitting on the terrace of my villa in Palm Desert over the seventh link of the golf course, and therefore I had a slightly different perspective on the markets, and one that might be a bit more relaxed. But just telling you that in the past, I've always found that the further I get away from the markets, the more accurate I am. So I will give you my feelings that I felt very strongly that the markets were in really excellent condition. And remember last quarter we talked about ROIC, or return on investment capital. And it seemed clear to me that that was continuing to come through very strongly in the markets during the first quarter, increasing dividends, more M&A activity, and while there was some excesses in new issues, I definitely felt that that continued to really look quite good for the markets as we're going forward. The other things that we talked about were more value stocks, and I felt very comfortable with that as well. Value, larger companies seem to be making a shift away from the growth companies, which may have gotten a little ahead of themselves. So we'll cover all of these things, and possibly the one biggest area in the material that we looked at was the 5-year anniversary. The 5-year anniversary of what had been a very, very negative market, which turned and recovered not only all of the previous losses, but actually went to new highs. So these are the things we're going to cover. But first of all, let me make sure to introduce. On my right is Bob Toomey. Bob is the head of research and a vice president of the firm. And on my left, Len Skeena, who is of course also a vice president of the firm and actually now the CEO, which I assigned him at the last board meeting. Anyway, without any further ado, I'd like to turn to Len to discuss the international markets, which continue to look pretty good as well as our own U.S. markets. Len?
Thank you, Stan. The international markets right now are something of a mixed bag. The more developed markets in Europe have been in a period of recession. They're coming out of it. They're starting to recover, but the recovery at this point is somewhat weak. It's a little tepid, and we're not completely buying into it being a full-blown case of something that we're excited about. We are glad to see that they put a lot of the crisis behind them. They've still got some rough waters ahead, but it's not something that we feel at this time we want to overweight by any means. Of course, as we look at the rest of the world, China is on the other side of things. They've been in a period where they've been growing so fast that they're forcing themselves a slowdown. And that forced slowdown is going to have an impact on a number of other countries, probably no place more so than in the emerging markets, which are much more dependent on what's going on in China than even we are. If we're going to be looking to see where do we really feel comfortable at this point, we're going to continue to do what we did last quarter, which is to emphasize the developed markets rather than the emerging markets. We're going to continue to favor a broad-based index of those developed countries in the EAFE index, which is the Europe, Australia, and Far East index. And we're going to continue to underweight international a little bit, while we still remain much more enthusiastic about stocks in general in the US, but we're not going to go with a full allocation on the international front at this time. To talk about exactly why we're excited about the US stocks, I'd like to turn things over to Bob, and maybe Bob can discuss just why we are so excited there.
Thanks so much, Len. So with looking at the US economy, as most of you are aware, we kind of muddled through in 2013. More of the same, ended up being around a 2% growth rate last year, We see that accelerating somewhat this year. We think that the U.S. economy can grow in the range of 2.5 to 2.7%. That happens to be about where the consensus is right now, and it seems reasonable to us. The reasons for that are continued growth in corporate capital spending, steady growth in employment, and also corporate profit growth, which we think will continue to remain strong in the range of 6 to 8%. Inflation right now continues to remain subdued in the 1 to 2% range. We see that continuing. There are some negatives, however, with respect to the U.S. economy. We have a very high level of structural unemployment in the U6. We think that that's going to be a little bit of a drag on the economy. U6 is the term for long-term unemployed, and that continues to remain way above long-term averages. We also see the Federal Reserve tapering quantitative easing. We think that that could have some potential drag effect on the economy. And it was interesting to note so far this year, long-term interest rates have actually declined from the beginning of the year, which is a little bit contrary to what many people thought leaving 2013. And I think that that's telling us that the market thinks that the growth may not be quite as fast as we had expected. That said, equities still offer an attractive vehicle for capturing growth, and that is a result of corporate profit and cash flow growth, which I mentioned is going to continue to remain pretty strong at 6 to 8%. Valuations continue to remain reasonable, about 15 times earnings. That is about in line with the long-term average. So with respect to sector exposures, we did maintain our exposure to healthcare and technology. We think those are good, strong secular growth stories. We did initiate a position this quarter in timber and forest products. The reasons for that are we believe that there should be continued good underlying demand from growth in the housing industry, with the potential for some supply constraints looking out a year or two for timber and lumber products. So we raised our exposure in natural resources to the high end of the range, and all that, again, primarily favors U.S. exposure.
Thanks, Bob. I'd like to revisit just for a moment our decision to go to the high end on natural resources, and actually like to share with our participants why we went into wood. It's a clever symbol. The symbol actually is WOOD, and it's an area that we've not ventured into before. And you're bringing that to our attention, I think, ultimately is going to be a very, very good decision, and gave us the capability to look at things that would be more sensitive to inflation. So I wondered if you'd like to add just a little bit more to that wood decision, because I think it gives an idea of just exactly the kind of thinking that goes into these meetings.
Sure, I'd be happy to. So I had been listening to several economists, particularly the former Weyerhaeuser economist recently at a conference, and he was quite bullish on the outlook for lumber prices longer term. So the fundamental forces driving that are stronger housing environment. We do think that housing will continue to remain one of the faster growing areas of the economy. Also, there is a strong export demand going over to China in particular out of North America. So you've got continuing demand for that lumber or timber supply. And up in British Columbia, they have suffered a very severe infestation of the mountain pine beetle, which has devastated about half of the pine forest in British Columbia, and it's now moving east through Alberta. And so we think we're going to see a fairly significant reduction in Canadian timber availability, which over the next couple of years, now it may not happen right away. We didn't buy this as a 1 quarter or 2 quarter investment. This should start to play out over the next couple of years as Canada wears down through its inventory of available timber and lumber, and housing continues to grow. So it's a 1 to 2 year play, and those are the fundamentals driving that decision.
Thanks, Bob. I really do appreciate you adding more meat to the bones, you might say, on that decision. I do think it's an important one as we go forward towards looking towards more inflation in the future. and actually a new way to capture that inflation sensitivity. But now I'd like to go back over to Len because he's going to handle the 5-year anniversary. And the 5-year anniversary had so much play, and there was so much activity around the 5-year anniversary. Could the markets continue, et cetera, et cetera? And it seemed like there were people going out of their way to make the 5-year anniversary a negative. But we didn't quite look at it, did we, Glenn?
No, we didn't, Stan. You know, as Stan was saying, the media portrayed this as a very negative thing, that generally speaking, bull markets don't go much beyond 5 years. And in fact, I saw a commentary where they were discussing the fact that of the last 6 bull markets that went 5 years, 3 of them did not make it to the 6th year, completely ignoring the fact that 3 of them did make it to the 6th year. One of the things that is important to keep in mind is all bull markets are not the same. And the reason bull markets end is when the conditions that created that bull market and the things that were driving stocks higher are no longer present. We don't see that being the case here. This particular bull market started because valuations were so very, very low after the financial crisis. And even with stocks having climbed to record highs now and stocks having climbed for 5 consecutive years, we are now at a point where stocks are just fairly valued. They're not overvalued. We continue to see continued growing and strengthening of the U.S. economy. We're seeing strong fundamentals wherever we look, and we're not at this point terribly concerned about the idea that some arbitrary round number of 5 years happens to have just passed. In fact, we're celebrating the fact that it's 5 years. With that, we do see some sectoral shifts going on within the U.S. economy, and I'd like to discuss or turn it over to Bob to discuss some of those things. Bob, can you?
Sure, happy to do that, Len. So at our meetings, we go into an analysis or discussion, I should say, of international versus U.S. exposure. We also talk about, as Stan mentioned earlier, value versus growth. Value versus growth was a fairly lengthy and lively discussion in our last meeting. So I want to share a little bit of that with you. So look at international. You've heard us say a couple of times, it bears repeating, that right now we still favor U.S. equities over international in general. Large cap and developing exposures in your portfolios are at the high end of our allocation ranges. And the reason for that is the U.S. economy continues to deliver the fastest overall economic growth in the developed economies. As Len mentioned earlier, China is in a kind of an engineered slowdown, going from hyper growth of over 10% down to something in the 7% range. And that will continue to have an impact on emerging markets. And we still think it's a little bit early to recommit exposure to emerging markets at this point. So the point being that the risk reward for U.S. stocks, we think, is still more attractive. And that's why we have been favoring U.S. With respect to the value versus growth argument, just a couple of points to note there. Growth has outperformed value for the past 6 years in the large cap area. And small cap, particularly small cap growth, has outperformed large cap for most of that time period as well. So we're really thinking about where do we see relative value. We did shift some emphasis towards value in the second quarter. The reasons for that are, as I said, relative valuations of value versus growth. Looking over the historical relative valuation looks attractive for value. A lot of value in there. Continued emphasis on dividends, particularly we like cash flow in the portfolio, and the larger cap value stocks tend to be higher dividend paying, and that enables us to generate more income in your portfolios. And finally, if interest rates do recede a little bit, if growth is a little slower this year than we expect, that would favor large cap value, again, because of the perception that they will deliver higher dividends and income in the portfolio. So we did increase our weightings both in large value, and we added some exposure in small cap value, again, to capture that shift towards value.
Thanks, Bob. Once again, the emphasis was on high quality, moving more towards the value, which I think you explained quite adequately. But of course, we can't ignore the elephant in the room, so to speak. We've consistently questioned what's going to happen to interest rates, how we handle that in the bond part of our portfolio, and no exception at this meeting. We had the same issues and the same challenges. So Len has the distinct benefit of being able to talk about those adjustments that we made. Len?
Sure, Stan. We continue to see the bond area as an area where we want to weight things more towards the short end of the bond curve rather than the long end of the bond curve. As Stan said, this is not a new problem. We've been looking at this for a while, and we see interest rates going up from where they are. Maybe not a large spike. In fact, we're not anticipating an enormous spike. But we do believe that the bull market in bonds ended in June of 2012, and that interest rates since that time have been creeping up and will continue to creep up. With that in mind, knowing that longer term bonds are more interest rate sensitive, we're skewing things towards the short end of the curve. There's going to be continued emphasis on things that are going to be driving interest rates higher because there's going to be continued credit requests by corporations as well as by individuals. There's going to be continued quantitative easing by the Fed, and the U.S. economy continues to strengthen. And with all of that going on, we're going to continue to try to do what we've been doing, which is protecting you against those interest rate increases. With that in mind, one thing that we are doing is recognizing that with the U.S. economy strengthening, default risk is down. With interest rate risk being higher and default risk being lower, we see an opportunity to represent some of the longer term bonds that we have with high yield bonds, which will give additional income in your portfolio while at the same time protecting you a little bit against that interest rate sensitivity. So with that in mind, that's where we are, and that's where we will stay for the next quarter.
Well, thanks, Len, and thanks, Bob, and thank you for tuning in again to this quarterly update. Again, you can see that we are generally positive on the markets. We didn't mention REITs. We saw them as continuing to be a major part of the portfolio because we still continue to like the returns on those in addition to all the other things that we mentioned. But again, as you look at your portfolios for clients, they are very much within our normal models. We are not generally tending to overweight except the shift that we mentioned, going more towards as much income as we can put in the portfolio and more towards large cap value and even value coming in on the small cap area. So I hope that you tune in again next quarter and hope you have a very good day.